Cost of capital. Today we are going to assess what is the cost of capital and when to take decision either to accept this finance decision or not. But before we start of cost of capital, we have to differentiate between three decisions. The first one, it is the investment decision. And this investment decision is looking for the assets, the machines, the equipments, what kind of assets. So if these assets enough or not enough to carry on profit or not. And then we go to the two aspects. The first aspect for the investment decision, it is the capital budgeting techniques that we explained it in the previous video. You can return to it. And then the second step, which is the working capital management, which is the video that we're going to see next to this one based on managing current assets and current liability. So after we did the financial decisions concerning investment, we need to look for how we are going to finance this decision. What are the tools of financing? It is going to be financed through debt, which is represent one of the capital structure components, or we are going to finance it by equity. And then we need to find the cost of each one of the debt and equity. And this is what we're going to give it a term weighted average cost of capital. Then we can compare the weighted average cost of capital with the net profit margin. We can compare it with the internal rate of return, return on investment capital, and then we can take decision either to proceed with this investment or not. And then the dividend decision, which is we're going to explore later. So we have three decisions in any financial decision: what is the investment, financing, and dividend decisions. And this is based for the corporate practice. So the cost of capital, when an investor providing the corporation with fund, investor is expecting that the firm will pay appropriate return. So what will be the appropriate return? Maybe this return we can calculate it from the net profit margin. So how much is this net profit margin? How we can calculate the net profit margin? And then we need to compare this net profit margin with, or this return with the weighted average cost of capital. And this is what we are going to look for: the cost of capital, cost of equity here. And here we have to look for the two pair of points, which is the return is called the cost of equity. What is the cost of financing these assets? So from the point of view of the firm, and this is what we call it, cost of equity. Most firms have different types of capital. As we said before, capital structure consists of common stock, preferred stock, and debt. So let's see how we can find the cost of capital. And this cost of capital, as we explained in the previous slide, it is consist of debt and equity. And the equity, as we explained the stock before, it is split into preferred stock and common stock. So if I know the capital structure, so this word means the capital structure. What is my capital structure? Capital structure. And we need to look for these weights. What is the weight of the equity? What will be the weight of that? So let's say I will have an equal weight. So 50% of my capital structure will be financed by debt, and the 50% of the capital structure is going to finance by equity. So this is the weights, and this is the most important part to calculate the cost of capital. And then we can compare the cost with the weight. So what is the weighted average cost of capital? So the weighted average cost of capital is based on how I am going to finance my assets and how my debt and equity is enough or not. So if we look for the capital structure in this combination of debt and equity, so you will see that the common stock is the highest risk. So it will have to be given to the shareholders or stockholders amount of dividends according to their participation of the capital. And the lowest part is the senior secured debt. So as we said that it is the asset part, and this is the parts where we're going source of financing my capital. So current liability, long-term debt, stock equity, preferred, and common stock, and then return it. So we can summarize simply the weighted average cost of capital. It is split into equity and debt, and the equity is based on the risk premium that we are going to calculate it from the difference between the risk-free and the market rate, and this is give me the risk premium. times the beta, which is represent the risk and return in certain industry, plus the risk-free rate. And this is the most important part of equity, and this is what we are looking for. So this is called cost of equity. And then what is the cost of debt? The cost of debt, it is the average debt yield in this organization times its tax shield. So the tax shield, it is 1 minus 4. So this is will give me a minus 40% the taxes, which is usually in the developed countries. So I can get the debt cost. So then we have the cost and we have the debt. So we can multiply the weight times the debt. So overview of the cost of capital, it represents the cost of financing as it is the minimum rate for the project must earn to increase the firm value. Financial manager usually ethically bound on to only investment project that they expect to exceed the cost of capital. The cost of capital reflects the entirely of the firm financing activity. Most firms attempt to maintain an optimal mix between the financing by debt and by equity. So let's give an example to compare between and understand the different approach of financing any project. So a firm is currently facing an investment opportunity, assuming that the following best project is available. If this is the cost, the total amount of the project is 100,000 and it is will maintain for 20 years. It is expected the returns is 7%, and least costly financing is by debt, which is 6%. So if you look here, we are going to compare between the cost, which is here, the 6%, which is the 6%, and we are going to compare it with the return, expected return, which is 7%. So if the return is more than the cost, then we can accept the project because this is very good because the return is higher. And how we can take the decisions is by comparing between the cost and the return. So if I have another project and the expected return, it is expected return is 12% and it is expected to be financed by the simple way to finance it is by equity, but here the cost of equity is higher. So the cost of equity is 14%, and this 14% is higher than the expected return, which is 12%. So in this case, it is not good to finance this project or to go for this project because here the cost is higher than the expected return. So it is not going to cover the cost, so it is not good practice. But if I want to minimize this cost, if I want to make diversification, if I want to make a mix of 50 and 50 between the debt and equity. So if I recall the 6%, which is the cost that we have been given in the previous example, this is the cost, and this cost is 6% cost of debt. And I have another cost, which is the cost of equity, it is 14%. So as you see here, it is 50 and 50%. So if we go for the 50 and 50%, which is the weight, so what I did, I multiply the weight times the cost, the weight times the cost. So then we can find the weighted average cost of capital. And the weighted average cost of capital is one of the good practices because it is making diversification and diversification to minimize risk. So if you see here, the expected return here is 12% and the weighted average become 12%. So I succeeded in decreasing the cost of capital by diversification, and this is what we are looking for. So this is the idea of making diversification. So let's start by calculating the rate or the cost from the perspective of a company. So if I have been given a sales here and the COGS of a company, and they are having a capital of 5 million. If I have in the first case that I'm going to finance it by equity, then it will be the 5 million all by equity. But if I'm going to finance it by that, then there will be an interest. And this interest will be 10% of the 5 million, then it will be 500,000. And the tax rate is 40%. I want to give you the essence of the meaning of the cost of the debt. So let's see here, if I finance it by equity, so if the 20 million minus the 10 million, this is giving us the earning before interest and tax. So there is zero interest here. Then the earning before tax, only 10 million. I will put a tax by 4 million, then the net income here is 6 million. But if in the case of the debt, I will remember reminding you by the 500,000, which is the 10%. What is the 10%? Remember the capital. Here the capital by equity. By here the capital is completely by debt. So I have a 5 million, and then I multiply this 5 million times the 10%. This is will give me the interest rate or the cost of financing this project. So the interest rate is 500,000, then the earning before tax is 9,500,000. So if we subtract, we find that the amount of taxes will be imposed on a lower rate and a lower amount. So here the tax saving will find that you save 200 in comparison between the 4 million and the 3,800,000. So the net will be 5,700,000. So what did I save? I saved only 200. So how much I pay? I pay 500. So if I want to reflect on how much it did the cost, so I pay 500,000. I pay 500 minus the 200 which I save. So what I pay is just 300. This 300 divided the 5 million, it will give me the cost of the debt. So this is the cost of the debt for financing the project by debt. So let's see how we can calculate the cost of the debt instead of having it as a whole. So 500 minus 200 give me 300. So 300 divided the 5 million times 100 is just the 6%. So what is my tax shield? It is 1 minus 40. So the cost here, it will be 10%. What is this 10%? This 10% will reflect the cost. But it is here the net real effect interest rate. This is the real. But this one it is the nominal that I have to pay it for the bank. But I subtract 1 minus 40. This is give me 6%. So the cost of the debt now, you can understand that it is representing the 10% times 1 minus the tax. Brilliant. We finish the cost of the debt. So I would like to relate what will be the implications of comparing of having the same cost of debt, which is 13%, but the taxes is increasing in this example. The tax is 0, 20, 35. So the taxes is increasing and the tax shield here it is as well decreases. So 13% times 1 minus 0 tax is giving the higher cost. So the cost here is increasing with the increase of the tax rate. With the increase of the tax shield, you will find that the cost will decreases. So there is an inverse relation. With the increase of the tax shield or the tax rate, then the cost of that will decreases. So let's give an example to understand how we can solve if you have a Yara here and she is targeting to have an outstanding company and 10% Boom bond and it is yield 12%. So the 12% which represent here, this is the cost that I'm going to pay. And the tax here is 35. So simply, I will substitute by the 12% times 1 minus 0.35. This will give me the 7.8%, which is the cost of the debt. So this is how we can find the cost of the debt from different perspectives. But what happened in the previous example, the debt was cost yield to maturity, it was 12%, while here the cost of the debt it is 8%. So you find here by having a lower cost of debt, then they have a lower cost, have lower interest rate here, I will have a lower cost of debt. So if you see here, it is 12% yield to maturity. So if the yield to maturity increases, the tax and the cost of debt increases. If the yield to maturity decreases, then the cost of debt decreases. So this is the relations between the yield to maturity that we explained previously in the bond valuation and here the cost of debt. Let's go for the cost of preferred stock. So the cost of preferred stock is the dividends divided by the net proceeds we have here. And the net proceed, it is the net after paying the flotation costs or issuing costs. So if you remember the preferred stock, which is here giving you a fixed dividends. So this is fixed dividends is important because this is what differentiate fixed dev, which differentiate between the common stock and the preferred stock, which is fixed value or percentages. And then we need to compare how much the company is going to pay from the net proceeds, how much it is going to pay. So let's see here, an ABC company have a 50 million share, par value is $10, and you need to find the cost of preferred stock. So the cost of preferred stock, it is very simply because if you see here, it is the 50 million, as you know, and this 50 million, I'm going to pay only from this 50 million the 9%, and this is the dividends that we are going to pay for the company or for the people who have a shares of preferred stock. So it will give us 4 million and a half, 4.5, 4.5 out of the 50 million. So this is the debt. Left for me the net proceed. Net proceed, which is the net after pay. So you have here the 50 minus the 2 million, then this is will be the 48. So it is very simply, then you can find the cost of the preferred stock, and the R stands for the cost, and the preferred stock. So I will just put 4.5 divided by the 48, and this is represent the times 100 would give me the rate, then it will give me 9.38. So this is simply how we can find the cost of preferred stock, which is one of the easiest calculation where you can figure it easily, but the most important is to find the flotation cost. So let's go for another example here. A corporation is contemplating an instance of 10% to preferred stock. So this is giving me the value of the dividends, 10% of preferred stock. So that where the value of the share, it is $87. So 10% times $87 will give me 8.7. So this is the 8.7. How much is the flotation cost? The flotation cost is $5, just $5 from the 87 to 82, then it will give me the cost of the preferred stock. So we finished the cost of debt, we finished the cost of preferred stock, left for me the equity, and which is the common stock. We are going to use the capital asset price model and the discounted cash flow. So what is the capital asset price model? It is one of the most important model where it aggregate both the risk and the return in the same formula. So here the RS stands for the cost of common stock, and the risk-free, which is the bond that we explained it in the previous video. And here the market rate and the difference between the market rate and the risk-free, it is called market risk premium. Time with the beta. So here the beta, which is reflect, as I mentioned, the relations between the risk and return for this specific industry. So if the firm WACC increases at the beta and the rate of return on equity increases, then an increase in WACC means a decrease in the valuation and increase in risk. So this is important because this is the most important part here where we can grab the essence between the WACC and the beta here. So let's summarize it. If the firm WACC increases, if the WACC here increases, become higher, a firm WACC increases, and the beta rate of return increases, and the beta here increases as well. This means that you have here a lower decrease in valuation. Then the valuation is going to decrease, and here this is represent an increase in risk, so increasing the risk. So do the risk is important. You can see the risk in the next video where we compare between the risk and return. So this is important because this is the capital asset price model, one of the most important model, where here this model is reflecting the required return, and it is specifically from non-diversible risk of a firm as measured by beta. And the non-diversible beta, it is important because this is will use in our model to estimate risk, and the formula would require the public company open stock beta. So this is the beta that we're going to reflect on how we can calculate. So simply, if I'm giving you a simple example, and the RS here of the common stock is using a capital asset price model, the firm is investing advisor to own analysis indicate that the risk-free, which is in the market here, is equals 7%, and the beta to reflect the risk and return, it is 1.5, and the market return equal 11. So here I can get the risk premium, which is the 11 minus 3. 11 minus 7, it will give me 4. 11 minus 7. 11, it is the market rate. 7, it is the risk-free rate of the bonds in the bond market. and then 1.5, and then we have the 7%, which is the risk-free. So I find out what is the cost of the common stock, which is RS. Then if I have the WACC, I can compare it with the cost. Let's go for the DCF, which is the one that we used it in the previous video when we are explaining the stocks. So here in the cost of common stock, you need to look for the new dividends, the future dividend, and the value of the preferred stock, which is using discounting and taking into consideration the gross. The gross, we explained it in the previous model, which is the return in equity times the retention ratio. So here we need to look for the issuing cost of this stock, and then we can figure out how can we calculate the RS. So let's see here, we can calculate the annual rate here, which the dividends is growing. So here the dividends is growing from 2007 to 2012. And here the given rate, it is of 5%. And he is giving you the formula for simplicity here, all are given here. So I have a growth rate of a 5%, and I have a price of 50 P note now discounting, and the dividends is $4. So this is brilliant because this is the $4, and here it is the dividends, and then this is the net proceed or the discounting, which is the 50, and finally we're going to add the growth rate for this common stock. Then you got out the common stock rate. So we have been providing many examples for calculating the cost of capital structure, and I would like to share with you a very interesting example now. So if the company is having a 100 million share par value, and each is worth $5, so 5 times 100, it is 5 times $5 times the 100 million share. So this is 500, and this 500, it is the total amount, 500 million share. And if I want to take percentage of it for the dividends, then the dividends will be 10% of this 500. This is giving me the 50. So this is one of the very easiest example, one of the easiest one. Why? Because if I know the total shares and I got the percentage, times the percentage, this is will give me the DAV, which is important. So the total is 500, and then I have the 10% here, then it will give me the 50 million. Perfect. Left for me, I need to find the P note of the price of the common stock right now. So I need to subtract the flotation or commission cost, which is here we have the 500, and the commission mentioned is 40. Then it left for me 460. So if I want to find simply how can I find the RSCS? So it is the cost of the common stock. So it is simply the 50 million that I got it divided the 460, and I need to look for the growth rate, which is given the 6%. And this is giving me the 16.87. So this is very simple because you use here the DCF model. DCF stands for the discounted cash flow. Another example, in the simplest way, we have a stock sell for $32 and the dividend is 2.4, so it is 2.4 divided 32 plus the 7% is giving you the cost of common stock. So cost of capital, it has become clear. So the weighted average cost of capital reflects the expected average future cost of the capital over the long time. And it is based on the weighting the cost of each specific of the capital and its portion of the firm capital structure. So we have the weight of the long-term debt times its cost, and the weight of the preferred stock times its cost, and the weight of the common stock times its cost. This is represent a one value, which is 1%. So let's see if a company, ABC company, total investment is 200. So this is the total, and then I can figure out the capital structure. So 100 divided the 200, it is give me 50%. So this is the weight. So basically I'm looking for the weight at the beginning. So this is the weight, perfect. And this is the weight, and the percentage, it is important. And when you write it in the form of 0.5 or 0.3, 0.2, etc. And then he give you simply directly the cost of each item of the capital structure, 15, 12, 10% for that. But pay attention, one of the tricks here, don't forget to take in consideration the tax rate for the debt. So I use simply the 50. This is the 50 of the debt times the weight of the debt, cost of the debt, which is 10%. So 50% times the 15. There is a typo here because it is 50. No, it is not typo. It is 50%. This is the debt, sorry. So it is the debt, which is 20%, and the debt here, it is 10%. So I use the 20 times the 10% times the 1 minus the tax that I have it here. This is the most important one. And then I will go for the second item, which is the cost of common stock, which is 15%. And this is what I got confused with. Then it is 50%. Its weight is 50%. So I will use this 50% to times the cost of the capital that I have it here. So it is 50. So the 50 times the 15, and which is correct. 50 times the 15. This is the correct one. And then we go for the preferred stock. What is the preferred stock? It is 12%. And here the preferred stock weight is the 30% because it is 60 divided by 200. It will give me the 30%, which is the weight here. So finally, I find the WACC, which is the 50 times 15, 30% times the 12, 20% times 10% times 1 minus the 20%. So it is giving us the WACC, and the WACC will be 12.70. Perfect. So this is another example where we can see how we can find the weighted average cost of capital, and then we can compare it with the expected return as I did in the beginning. So another example, which is a very simple, cost of debt 5.6, preferred stock 10.6, cost of retained earnings, and the cost of a new common stock. And he gave me each of the weight the same way. And then all what is required from me, it is to multiply the weight, as I remind you, to put the weight in 0.4 times the cost, 0.10 times 10.6, 0.5 times 13%, and then you have the WACC. So let's go dig deeper in how we can do a detailed case where you're going to do all the problems together. So if I have a tax rate is 30% tax rate here, 40%, and I have been given the weights in the beginning and it is highlighted and it is asking me find the WACC. So if we can focus here, what is the tax rate is 40, investors expect return earnings and dividends in the future to be 6%. So he put the tax and he put the common stock, so they are not related, but focus while you are answering. And then he go to explain the dividends, it is 3.7, and the last share, therefore currently sell for 60. And then he explained for you the dividends. And then he come here and then he explained the debt. So if you see here that this is the debt, and he explained it later, and this is the bond yield at 6%, but it can be, that could be sold at an interest of 9%. So this is the interest rate, 9%. So I can use these values in order to find the debt. Market risk premium, it is important because I have to look for the risk-free for the bonds and how much the bonds is, the treasury is the risk-free, which is the 6% risk-free here. And beta here is 1.3, so I can use the DCF model, and then the new preferred could be sold in the public of $100 per share. So the easiest one here, it is very clear for me, it is the preferred stock, so I can start with the things that is come fast to my mind. So I have a preferred stock, so the cost of the common stock is, it will be the DAV $9 divided by the flotation that I have it and the price, so it is $95. So I can find here times 100, and then you can figure out how much it will be the cost of, it is not common stock, it is a preferred stock, and then you can find it in a very simple way where you can find the percentage here. Okay. And then the tax rate is 40, and the debt could be sold at an interest rate of 9%. So this is the debt. I have the debt which is in the cost of 9%, and it is important for me to look for. This is for me the risk-free, so it is 9%. times 1 minus L tax rate and 1 minus L tax, which is here, it's giving me 40%. So remember these values because the answer is coming soon. And then we have the dividends and we have the beta. So we have a common stock, the dividends will be 3.7. So it is very clear that I can find it, the RCS by finding the risk-free 9% plus the market rate, and the market rate here is given by the cost of the market. If you see it here, it will be, that will be sold at an interest 9%, and the market rate, the risk premium is giving directly 5%. He's not giving me the market, he's giving me the 5% directly, and then he giving me 1.3 the beta. So this is how we can answer each one. So I find the RCS, the RPS, the debt, and then I can multiply them times the 25, 15, and 60%. So let's see together how we can find it in a very simple way in order to find the WACC. So basically, this is the DCF model. I can do it here by two ways. I did it by the risk-free here, which is the yield, and 5% times 1 plus the 3. So we use the risk-free 6%, not the 9%. We use the 6%. And plus the 5% times 1.3, it gives us 12.5. And if he get me confused because the 9% was given before, so I can find as well the cost of common stock by using the 3.92 divided by 60 plus the 6%, which is the growth rate, then it gives me 12.53. So cost of preferred stock, it is the 9 divided the 95 as we did it. So times 100, it will give me 9.47. And then the cost of that, it is 9% here. This is what's giving clear 9%. And here, this is the interest. So I use it, the 9% times 1.4. So let's go back again. So we use the 9% for the debt. And we have the treasury bond yields. It's a 6%, which is the risk-free. I use it in the beta. And here I use this 3.7 times the growth rate, and he was giving me the growth rate in this formula by the 6%. So I can find it by using the DCF model and the CAPM model. And we can do average between both of them. Any one of them, it will be having a minor impact. So the cost of the preferred stock, which is the 9 divided 95, 9.47. And the cost of that, it is giving here 9% times 1 minus 40%. So finally, you will see that is 60, 15, 25, and we multiply the wait time with the cost, then it gives me 12.29. So if we want to compare it with the beginning, if the cost is higher than the expected return, then we are going to reject it, and vice versa. So this is the expected return that we can take a decision either to accept this bundle or this diversification or this capital structure. So assess yourself here. This is the last example. We have a company and have a balance sheet of 50 million, long-term debt 8%, and a yield of maturity is 7%. This debt currently has been the market value 55. The balance sheet also knows that the company has 20 million shares and the book value of the common equity is 65. So here the current stock price is 8.25 and the RS is 10% and the firm tax rate is 40% based on the market value. Return market value, assuming the firm is currently is targeting capital structure, the current same target capital structure, what will be the WACC for sales corporation used to evaluate capital structure technique and to determine the answer. So I will leave you to try to answer this problem and I will put the model answer in the comments. Best of success. I wish you that you understand the capital structure, cost of capital, and the WACC. Thank you. See you in the next video.